Silver is doing something dangerous right now, not because it's going up, but because it's not coming down. We're trading in the low 90s near all-time record highs after a vertical move that should have triggered profit-taking, stop runs, and exhaustion. Instead, it's just sitting there, pausing, hovering, refusing to give ground. That's not normal rally behavior. That's constraint. That's pressure building behind a valve that won't release. If you're holding silver, watching silver, or waiting for a better entry, this next stretch matters more than the last 5 weeks combined. Most people won't notice what's happening here until it's obvious. You're seeing it now while it's still uncomfortable. Your job isn't to predict what happens next. It's to understand why markets behave this way, recognize the pattern, and know what to watch so you don't get caught reacting when everyone else panics. So, let's break it down. Quick ask before we go deeper. If this kind of pattern breakdown is valuable to you, subscribe. This channel exists so we don't have to chase headlines. We read the tape together, we watch the signals most people ignore until it's too late. Here's what actually happened. Silver ripped from the mid-80s into the low 90s in a matter of days. That's not a grind, that's acceleration. Historically, moves like that attract sellers, hit technical resistance, and trigger at least a short-term pullback. Except it didn't pull back. It paused, consolidated, stayed elevated. And under that price action, things started flashing that most people aren't watching yet. Lease rates creeping higher, physical premiums staying sticky, warehouse inventories not rebuilding the way skeptics expected, commercial hedgers and fund positioning no longer lining up the way they usually do near peaks. That divergence is the tell. If this were a normal rally, you'd already be seeing the pressure release. You're not. And that's the part that should make you pay attention. Let me name the pattern so you can recognize it again. I call it the refusal pullback. Here's how it works. Price surges hard and fast. Headlines follow. Alerts go off. Late buyers pile in. Under normal conditions, that surge exhausts itself. Sellers step in. Early buyers take profits. The market pulls back 3, 5, maybe 8%. That's healthy. That's how rallies breathe. But sometimes the pullback never comes. Price pauses near the highs. Sellers try to push it lower. They fail. Support holds. The market grinds sideways or drifts slightly lower, but never capitulates. That's the refusal. Think of it like a pressure valve. Normally, when you spike a market, the valve opens. Excess demand gets shaken out. Supply flows in. Equilibrium resets. When the valve won't open, it means something underneath is absorbing all that selling pressure. Either supply is constrained, or participants are being forced to hold instead of exit. That's not hype. That's mechanics. You see this across cycles, not just in silver, not just in metals. Any market where physical delivery, financing costs, or positioning stress can create asymmetric behavior. We saw it in lumber in 2020 before it tripled. We saw it in crude oil in 2008 before the final squeeze into 147. We saw it in silver itself in 2011 before the blow-off top above 48 os. I'm not saying we repeat those outcomes. I'm saying the structure is the same. When price refuses to pull back after a vertical move, it's telling you something about supply, positioning, or both. Right now, silver is giving us that signal. We're not collapsing. We're not even testing the breakout level. We're just sitting there, and every day it sits without breaking. The probability of a larger move in either direction goes up. Here's the key point. Refusal pullbacks don't tell you direction. They tell you the market is under stress. They tell you participants are trapped, squeezed, or positioning for something bigger. This isn't advice, it's pattern recognition. If you're in this market, you need to respect what this structure can do. If you're on the sidelines, understand that waiting for confirmation often means you're already late. We're in the zone where decisions get made, and if you're not paying attention, they get made for you. Here's the kicker. This is the part of the cycle where people make the wrong decision for the right reason. There's a second pattern layered underneath this one, and if you don't understand it, you'll misread what's happening right now. I call it the physical first squeeze. The key idea is simple. Physical tightness shows up before paper markets react. Not after. Before. It starts in the real world. Premiums on bars and coins creep higher. Delivery delays stretch out. Wholesalers start talking about allocations. Lease rates, the cost to borrow physical metal, tick up. Inventories registered for delivery on exchanges like COMEX or held in LBMA vaults stop rebuilding the way they're supposed to. At first, nobody notices. It's not a headline. It's a phone call, a delay, a premium that shouldn't be there. Then the paper market catches up. Futures spreads tighten. Front month contracts start trading at a premium to deferred months. That's backwardation. That's the market saying, I need metal now, not later. By the time price reflects that stress, physical tightness has often been building for weeks. That's why people get trapped. They see price surge and assume it's speculation or hype. They wait for the pullback. They plan to buy the dip. But if the move is being driven by physical constraint, there may be no dip. Or the dip is tiny, gets bought instantly, and never comes back. Imagine you're a commercial user. You need silver for manufacturing. Your supplier tells you delivery just went from 2 weeks to 6. You don't wait. You buy forward. You lock in supply. You bid higher if you have to because delay costs you more than premium. Now multiply that across industrial users, mints, ETFs, meeting inflows, and funds that sold, short assuming they could cover easily. That's the squeeze mechanism. It's not about bullish sentiment, it's about availability. Once it starts, it compounds. Securing supply removes metal from circulation, forcing the next buyer to pay more, which removes more metal, and so on. We've seen this before. In 2021, nickel exploded on the London Metal Exchange when a participant couldn't deliver, and the market froze. In 2008, rhodium went from $1,000 to $10,000 an ounce because a tiny market met forced buying. Silver is bigger and more liquid, but the principles are identical. Right now, we're seeing early-stage signals. Lease rates creeping up, physical premiums not collapsing, inventory draws not being offset by new inflows. None of this is conclusive, but it's consistent with a market where physical availability is becoming the binding constraint, not price. And when that happens, paper price has to adjust. Or time does the rationing for you. Everyone's asking if silver's expensive. That's the wrong question. The right question is whether it's tight. Here's what you need to sit with. Markets don't top on excitement. They top when pressure disappears. Right now, we have the opposite. Pressure that won't release. A market that won't pull back. Physical flows that aren't normalizing. So you're sitting between two forces. On one side, people fading the move because it feels overbought. On the other, people seeing tightness and thinking the move hasn't even started. Both can't be right, and both can get hurt if they're reading the wrong signals. Chasing here without understanding structure leaves you vulnerable to a sudden flush. Selling here, assuming it's a top, risks getting run over if the squeeze accelerates. This is where discipline matters more than conviction. From here, there are only a few paths. We could break decisively above the low 90s, hold it, see volume expand, premium stay firm, lease rates spike, and shorts cover. That's acceleration. We could grind sideways for days or weeks, letting time do the work while physical tightness persists. That's digestion. Or we could reject hard, lose the mid-80s, see premiums collapse, inventories rebuild, and the stress disappear. That's resolution lower. I'm not predicting which one we get. I'm tracking signals so I can adapt. I'm watching spreads between front month and deferred contracts. I'm watching warehouse flows. I'm watching physical premiums. I'm watching where we close each day relative to the highs. And I'm watching fund positioning to see who's actually uncomfortable. If you're trading, respect volatility and use stops. If you're holding, size your position so you can survive sharp pullbacks. If you're waiting to enter, have a plan for both a breakout and a rejection, so you're not frozen when one shows up. Here's the bottom line. Silver is showing a textbook refusal pullback layered on top of early physical first squeeze signals. That doesn't guarantee a breakout, but it does tell you the market is under stress, and stressed markets don't resolve quietly. If you're watching signals instead of headlines, you're already ahead. You're not reacting, you're reading. And when the market makes its move, whichever way it goes, you'll have context instead of emotion. Drop a comment and tell me what you're watching most closely right now. Spreads, premiums, price action. And if this helped, subscribe. We do this every week. No hype, no predictions. Just framework so you're not flying blind when markets get weird. Final thought. Markets don't top on excitement. They top when pressure disappears. Right now, pressure is building, not fading. Stay sharp, stay disciplined, and know what you're watching.